The information and opinions presented in this Arc Energy Ideas podcast are provided for informational purposes only and are subject to the disclaimer link in the show notes.
This is the Arc Energy Ideas podcast with Peter Tertzakian and Jackie Forrest, exploring trends that influence the energy business.
Welcome to the Arc Energy Ideas podcast. I'm Jackie Forrest.
And I'm Peter Tertzakian. Welcome back. Well, Jackie, we've got a new federal budget.
Yeah, big news with the 2023 budget last week, and lots to digest and lots of implications for the future of investing in clean energy in Canada. So, it's a big topic. We're not going to cover it today, but our next episode, we will give you the lowdown on how we think it's going to affect investment. No spoiler alerts today on that, so stay tuned for our views on the budget. But hey, there's other things that are going on too. Like a couple weeks back, we had the Young Women in Energy events. Yeah. So each year, the Young Women in Energy gives out awards to exceptional women in energy. And I think it's a great initiative. I give great recognition to Katie Smith-Parent, who leads this, and she has for 7 years. And it's really to foster a community for young women in energy and hope that they stay with us, because the statistics show that a lot of women leave the industry. And when we may have a fair amount of women in the junior parts of their career, but as they get into more senior roles, less and less women are in the industry. So I think it's a great initiative. I was a judge this year, so it was a great event.
And I've been a judge. I think I was a judge in the first year 7 years ago, or 6 or 7 years ago. It's really an impressive group of women who are the leaders of tomorrow. So big shout out there. And they gave us a shout out too.
Yes. So this year they had a great magazine, which I really enjoyed reading. It has stories from the recipients this year, but also articles written by past alumni, I guess, of people that have won in the past over the last 7 years. And the very end of it, they have asked the alumni to recommend podcasts. And we were really thrilled to find out we were the #1 recommended podcast. So thank you, Women in Energy, for that.
Thank you.
All right. Well, talking about energy, we want to talk about how much money is being spent on clean energy and what the future is.
Right. And so today we have our special guest from Bloomberg New Energy Finance, otherwise known as BNEF. And we're delighted to have the co-CEO, Albert Cheung, who's joining us directly from London. Welcome, Albert.
Thanks, Peter. Thanks, Jackie. I really appreciate you having me on.
Good. Well, maybe tell us a bit about the firm. I mean, it seems to be getting bigger every year and getting more quoted. And your role, I understand you're recently into the role of Deputy CEO.
Thank you for letting me talk a bit about BloombergNEF. So we were founded as New Energy Finance back in 2005, and we had this hypothesis that low carbon transition would be the most important theme of our lifetimes in terms of investments. It would create enormous opportunity and transform the energy markets, and that good data and analysis would be a key enabler. That's kind of what we believed. I like to think, here we are nearly 2 decades later. I think a lot of that has now, I would say it's safely been borne out, that thesis. I've been there for much of the firm's life. I joined in 2009. Shortly after that, we were acquired into Bloomberg and became BNEF, as we now like to call ourselves. And yeah, a lot has changed for us. We've grown a lot. I think we're around 300 people now globally in roughly 20 locations these days. It's great hearing you talk about the Young Women in Energy, because we actually recently achieved a 50% female gender ratio in our team, which we're very proud of. It took a long time to get there. I think we're a much more diverse and inclusive team now than we ever were before, although there's still some ways to go on different dimensions and different seniority levels. So we know there's further to go on that. But look, energy transition is much broader now than it was back then. And that means there's more demands for us and more demands for our time. So I actually wear 2 hats now. I've been the head of global transition analysis for about 5 or 6 years, looking after all of our research on the low carbon transition globally. And then recently took on this newly created role as deputy CEO, really to try and spend more time with our clients, given the great demand for our work. And the idea was to have me also help to represent the company alongside John Moore, our CEO, among our clients. So I'm really looking forward to that new challenge. It's all very fresh.
Well, it was only less than a decade ago that if I walked into the office of a financial institution and said, hey, let's talk about energy, the implication was we're talking about oil and gas because it was so dominant. And really the new energy revolution really hadn't even, of course it was talked about, but it wasn't really being measured effectively. And that's one of the things that Bloomberg New Energy Finance, or BNEF, really started to excel in and now arguably dominates in many ways that measurement. But when you talk about energy transition, Speak to us about how you think about it, because we think about it sort of holistically as transition comes from the established incumbents of oil and gas, which are still, huge in the world, and the new world. Do you sort of take a holistic view?
No, it's a really good question. I think one place where we differ from maybe some of the other groups out there is that we started from the low carbon transition standpoint and then kind of backed into the markets as they exist today over time, because we recognize the connectivity and the importance of living in the world that we live in today and understanding how markets really work today. So where we are now is we do have that group of analysts that focus on the transition sectors and technologies like clean power, solar and wind and electric vehicles and hydrogen and carbon capture, those technologies that are going to drive transition. We also have groups of analysts looking at the commodities markets, both the kind of short-term traded markets today. So think of gas and power and oil and carbon and even metals. But those teams also take the long-term view of where's that all going? What's the impact of the transition in these markets, and what are the implications for the companies that lead those markets as they navigate that transition? And we actually have other lenses as well. So we have the transitions, the commodities. We have country teams who focus on individual countries that are relevant to the transition and try and bring together the story of how countries are navigating that. And then finally, we have a group of analysts focused on what we call sustainability, which is how are corporates and financial institutions, A, managing their own footprint, B, navigating the opportunities and challenges that come with this low carbon transition. So I think we are holistic.
Well, let's talk about the future and and a little bit about what's happening with clean energy investment. I think the first question I want to ask you about is the U.S. Inflation Reduction Act. It's obviously changed the outlook for investing in the United States. Can you give us a sense of how much your outlooks for growth in clean energy have changed after that news came out in the summer that this policy was here? How impactful is it?
Yeah, absolutely. Look, the Inflation Reduction Act is the most exciting development we've seen in a long time. I think, like you and like many others, I think when it finally hit, it was this moment of incredible excitement and really kind of energizing for everybody. So since that moment last August, each of our teams has gone back and said, okay, what does this mean for our sector? What does this mean for the forecast that we have? And I can actually share just a few numbers from those reports. So we've upped our electric vehicle sales forecast for the US. It's now above 50% EV sales penetration by 2030, where it was previously in the low 40s by then. We've upped our solar installations forecast by about 10 gigawatts per year in the second half of the decade, and it hits about 50 gigawatts per year of installations by 2030. We've upped our wind installations by, in the region of 10 to 15 gigawatts per year as well. And all our expectations on other areas like hydrogen, carbon capture are all increasing as well. So it's having a material impact on the outlook. We're seeing a lot of opportunity, a lot of investment being announced. And we're actually going to issue a new energy outlook scenario in the next couple of months that will actually provide kind of, here's our view of the US energy transition, pulling all those different pieces together, given the Inflation Reduction Act, that will kind of tell the story of how it all fits together.
Good. Well, I'm looking forward to seeing that. It's obviously really driving a lot of announcements as well. One question I have is that kind of growth going to be achievable because there's going to be limits and how many wind turbines we can build or how many solar panels we can build? Have you considered that when you look at the growth outlooks?
Yeah, for sure. When we do our forecasting, we take into account all of the factors that you can think of. So we of course think about policy, and the IRA was a big part of that. But we also look at things like how big are the interconnection queues in different markets? How challenging is permitting? What are the trends in supply chains and how are costs evolving? And all of those, I should say a lot of those things are bottlenecks or brakes on our forecast. So if you remove those things, we go even faster because the economics of clean energy are getting better and better all the time. Oftentimes when we think about just the pure economics, things could go even faster. But the on the ground realities of things is that you have to kind of pull those forecasts back a bit. And that's how we end up with the numbers that we have.
Mm-hmm. So you've talked about supply chain potential permitting restrictions, so on and so forth. But what about capital? And you just actually did release Energy Transition Investment Trends Report. Global spending was 1.1 trillion American dollars in 2022, 31% gain over the previous year. Do you sense that the capital injection into the space is going to accelerate enough to sustain these sorts of sales projections or adoption, I'll call them adoption rate projections that you're upping?
Yeah, well, maybe let me first talk about some of the findings from that report, because I think that there are a few things in there that really caught the imagination. The first thing is that 1.1 trillion US dollars last year, that's the first time it's been in the trillions. And we know that we in the trillions globally, ideally more than one, ideally 3 or 4 trillion globally to get on track for net zero. And we can talk more about that. But the other thing that really captured the imagination was that we, as part of that report, we then went back and said, okay, well, how much is being invested in fossil fuel energy supply? And we did our own top-down estimate of that. And we found that number is also 1.1 trillion US dollars. And so we came out with this conclusion that for the first time, money going into energy transition technologies has matched money going into fossil fuel energy supply.
So, Albert, I mean, it's great that we're in the $1 trillion mark, and that's a major milestone, as you say, the same amount as what's going into the oil and gas. However, you also conclude that in order to get on track for your net zero scenario, spending would need to be 3 times higher for the rest of the decade. And, when I look at that, and by the way, the IPCC report just came out saying, well, you actually have to even go faster. It's got to be net zero 2040. Like, how practical is it, do you think, that we're going to be on track for these net zero scenarios when you see the level of spending? It's not even physically possible, I don't think, to increase 3 times because of all the supply chain issues.
Well, so when we do our net zero scenario, we're really careful to try and make sure that our scenarios are practically plausible and practically feasible. So we look at the supply chains, we look at the permitting, we look at the land availability and all those things. And in our net zero scenario, which we published towards the end of last year, we achieve a 1.77 degrees of global warming trajectory with net zero globally by 2050, with no overshoot. And this gets a little bit technical, but some of the other scenarios out there, when they include overshoot, it essentially means that they need to do net carbon removals for much of the rest of the century to get back on track. So they overshoot the carbon budget, and then the whole world has to be net negative to get on track. So we don't do that. We're trying to produce scenarios that are truly plausible and doable. And so within that, we have this tripling of investment required for the rest of this decade. Is it possible? Is it not possible? When I hear tripling, what I hear is it's a doubling and then a bit more. And if you've been in clean energy and EVs and these industries for the last 10 or 15 years, you get quite used to the idea of things doubling and things doubling every few years. And just to give you an example, the amount of renewable energy in the world has roughly doubled over the last 4 years. So out of all of the renewable energy added from the year 0 to the year, I think it was 2018, was when the world hit 1 terawatt. And then the next terawatt happened in about 4 years. So when you've been in these industries that are used to growing at that kind of rate, when you hear that things need to double and then double again, you get a little bit more relaxed than if you're in industries that are used to growing at 1 or 2% per year. So are things possible? They're possible, but there's a lot that needs to be done. And we can talk about policy, we can talk about regulation, all those things. But I think physically possible, I think we do address that.
Mm-hmm. Although tripling, it's probably got to be more than that given the inflationary environment we're in, and that $1 today doesn't go as far as it did yesterday.
So electrified transport was the biggest grower in 2022. It actually now makes up 40% of the 1.1 trillion in clean energy investment, and it grew over 50% year on year. So in fact, I think the latest data that you just put out showed that in Q4 2022, 19% of new car sales were electric, which is, to me, that seems ahead of what people's expectations are. Could you just comment a bit on if that's the case and why we're seeing electric cars grow at such a fast pace now?
Yeah, thanks, Jackie. So that 90% is actually pretty incredible. To think that 1 in 5 cars is being sold around the world as electric is I think for most people unthinkable a few years ago. We actually occasionally go back over our past forecasts and kind of look at, hey, were we right or wrong? And so one thing that's for sure is your forecasts are always wrong. You never get it right. But we've been wrong in both directions over the years. We've been over optimistic and we've been underestimating progress at different points in time. So we don't get it perfectly right. One thing is, I think people view us as being kind of one of the more aggressive forecasters out there in terms of electric vehicles. I think that may be true. And I think part of that is because we're a global team with a global footprint, it's allowed us to understand some of the dynamics in different market contexts and how sale can go quite quickly when the environment is conducive in particular markets. Places like Norway or China or California. And not everywhere is California, not everywhere is Norway, clearly. But I think those markets give you a bit of a clue as to the signals to look for. And it is things like those crossover points where certain vehicle segments start to become economic.
Mm-hmm.
Battery electric vehicles start to become either total cost of ownership economic against internal combustion engines, or even upfront cost competitive, which is largely still, a couple of years away. But those conditions have been created artificially in a number of different markets over time, like in Norway with the very generous subsidies that they have there.
Mm-hmm.
And so I think that's allowed us to take these little petri dishes in different markets and kind of apply that logic elsewhere. And, we still get it wrong. China tends to outperform. We tend to be wrong about China on the downside, and things move faster there. They have very strong policy, very strong ambitions from the auto manufacturers there who want to be leaders in these sectors. They want to be global leaders in these sectors. Whereas I think last year we actually got it wrong slightly on the downside, and Europe's EV growth was a bit slower in 2022 than we thought. And that was partly to do with supply chain issues that happened during the pandemic. We enjoy trying to do the best job we can at forecasting. It's not always easy, but we try to get it as right as we can.
Yeah, so the adoption rate of electric vehicles is impressive, and there's sort of supply chain distortions and things over the last few years, but there's no question that it's gone past an inflection point, and typically these sorts of sales adoption curves follow an S-curve, and there are many examples of S-curves in technology product adoptions where you go from zero to full adoptions, or almost full, like DVD players to streaming audio video. And there's many examples. But are those sort of tech adoption S-curve type, I'll call them sales curves, relevant to electric vehicles? And here's where I'm going with this. I mean, if you ask most people in North America, I can't speak for China, but they say, yes, I bought an electric vehicle. Oh, but by the way, I also have a combustion vehicle in the garage. So is the S-curve really going to go so that it's full substitution, or is full adoption something like, 60% electric vehicles in the fleet, 40% internal combustion engines? And I'm going to turn it over to you in a second, because, the example I like to think about is, say, stoves and microwave ovens. Like most people have both, certainly in a North American context. So just because I bought a microwave doesn't mean I got rid of my stove. So just because I bought an electric vehicle doesn't mean I got rid of my combustion vehicle. How are you thinking about that adoption in terms of the transition?
Yeah, it's a really good question. And the thing about S-curves is they're purely empirical. It's just what you see after the fact. And you can then apply some sort of economic rationale back onto it to do with the fact that, most consumers copy everybody else they see. So once you have enough EVs on the road, other people buy them because they see that, if my friend thinks it's good enough for him, it's good enough for me, kind of thing. So you can sort of retrospectively apply the logic onto it, but it's not a law of physics. And I think if you look at past S-curves and other technologies, it's not a given that they always go to 100. And actually, cars is an example of that. There was an S-curve on automobiles, and it's not 100%. Not every home in North America or in Europe has a car. Same thing with smartphones. You can still buy old-style brick phones. I'm not sure if anyone uses them for different reasons, but they exist.
Or turntables,
Yeah, exactly. I think with EVs, I think you raise a really good point about second car or two-car homes. I think that's something to pay attention to, that a lot of those homes have been the early adopters. And I think it remains to be seen how many of them, finally get rid of the other one. Norway actually gives us some clues. So Norway's been running at about 90% plug-in vehicles in terms of new sales for the last couple of years. So that's 90% including plug-in hybrids. I think it's only about 80% if you take pure electrics. It hasn't hit 100. You may ask, okay, will it hit 100 or not? And I think there's two key considerations there. I think one is, what do automakers do when you get to that 60, 70, 80% penetration? Do automakers still want to be in the market that's shrinking, that's low volume, or do they just give up on it? And then, like with phones, it gets harder and harder to find the brick phone because nobody's making them because it's not an attractive market. That's one question. I don't know the answer. I suspect the upper segment players and lower segment players may have different answers.
But do you think Norway's really the right example? Because, given their massive sovereign wealth fund from oil and gas, they basically subsidize the electric vehicles to such a great extent that it's compelling. That's not true of most countries in the world.
Yeah, I think that's valid. I think the way we like to think about Norway is that it is a postcard from the future, because at some point batteries are going to get cheap enough that the economics will look a bit like how they look today in Norway. That's not going to be exactly the same, and there's lots of other differences between Norway and every other country in the world. But there's some relevance to that the economic rationale will look a bit like Norway just got there way quicker by subsidizing very strongly.
Another thing, Albert, I read from one of your reports, you have a great electric car annual report, but you looked at Africa and some of these countries where electricity grid needs to be more reliable before electric cars will be adopted. I mean, you think of the challenges of building infrastructure in North America. When we already have a reliable grid, it's much harder. So I think you were quite pessimistic on adoption rates in some of those countries as well.
Yeah, I think that those a lot of emerging markets countries face multiple challenges. There's certainly the grid reliability and an infrastructure issue, and that is real. Actually, my wife is South African. We're in Cape Town quite often, and the energy reliability there is very poor, as you can imagine. So any conversation around electric vehicles is colored by that observation. But there's other issues too, just like purely a lack of funding available to fund the transition, because actually we're still not quite at that stage where electric vehicles are cost competitive. There's a lack of manufacturing, and battery technology knowledge, all of those issues. So I think there's a lot of work to be done there. And I think one of the things that we highlight in our electric vehicle outlook is if you want to achieve a global net zero electric vehicle fleet, we need to start paying attention to some of these emerging market challenges. It's not just a China, US, and Europe story.
Mm-hmm. Let's talk about China, because a significant portion of that 1.1 trillion is China. China is huge in the clean energy space. By the way, it's also huge, even according to the Bloomberg report and the Bloomberg analysts, in terms of the pull on oil these days. So talk about China and what's going on there.
China is the world's largest market for all the different kind of transition technologies. And frankly, it's kind of half of everything. That you pick your sector, it's probably half of the world's market. And that is exactly what we found in our energy transition investment report. It is half of the $1.1 trillion globally. It's about $550 billion of spending at the moment. We've got very strong policy around electric vehicles, very high ambitions around renewable energy. And currently they're in the process of building out these mega bases, wind and solar farms far away from load centers, absolutely enormous projects connected by HVDC. So it is absolutely by far the leader. And it's also the leader in factory spending. So as part of the work that we do is we track the deployment spending, but we also now are tracking the investment into the manufacturing facilities for the technologies for the transition. And China is not half, but actually about 90% of the spending on the actual supply chain and factories for the transition. So I think at some point you have to take your hat off and say China's done an incredible job promoting these industries. It's been very strategic, it's been very proactive, and as such has taken this very dominant position as we are today in the energy transition.
Well, when I looked at that number, what, 550 billion or something, it kind of got me thinking, we think about China, as you say, it's something like 90% of the factory, so like of where the clean technology is being produced. Of course, we think of them just all exporting products and trying to get rid of the competition outside of China, but they consume a ton internally. And policies like the IRA are trying to say, you know what, we don't want to depend on China anymore. We want to bring those supply chains home. But when you think about it, like China, they have so much of the world's technology and know-how today. It gets me thinking, like, is it going to be easy for the ramp up of these new industries when we barely have anyone outside of China that knows how to do these things? How long is it going to take? And I know you've seen some of the announcements where China's starting to be a bit more concerned about their technology and know-how leaving the country. And they're talking about things around wafers, not allowing, the production facilities or the machines that would do them to be exported. So do you think that's going to slow down the ability to build these supply chains other places?
It's a really interesting question. I mean, we're in a moment right now where the momentum around investing into the US and North America and kind of the sort of free trade agreement countries with the US, that momentum is really growing. We've tracked at least $35 billion in announced investments for the EV and battery space in the US. And I think it is going to happen. I think there is going to be a build out of local manufacturing and supply chains. And the IRA is clearly doing its job in attracting investment. I think we could have a discussion around location versus ownership. Should we be saying, actually, factories can be in North America, the factories can be in free trade agreement countries. They could potentially be owned by Chinese companies that have the know-how, that bring the technological expertise and the experience. Could we think about that? There are other Asian countries and companies that are pursuing those opportunities. And I think there's also a big question, which is really around trade-offs, because I do think the US, North America can be successful stimulating investment. But the trade-off is, you're capturing the value there, you're capturing the economic benefits and the jobs. And from a political economy's perspective, it makes a lot of sense.
Mm-hmm.
But you are creating inefficiencies. You are raising trade barriers and subsidizing, which your economics textbook tells you creates inefficiency, raises costs. So you may end up inadvertently raising the costs of the transition, increasing the taxpayer burden of the transition by trying to promote that local investment. Now, it's a trade-off that every country needs to make. No, it's not necessarily a right answer, but I think we should be aware that that is a trade-off.
Mm-hmm. Well, let's talk about the energy landscape. You spoke about investment, and we want to talk about where the money is going and where the money is sourced, the impact of these Silicon Valley bank failures, SPACs, and so on and so forth. But before we get to that, I want to talk about what's hot. Where's the money going? I mean, the energy landscape is so big, all the way from biofuels to hydrogen to batteries to solar panels to geothermal to wherever. Like, what's hot right now?
This is going to be an annoying answer, but everything's growing right now. So out of all the sectors that we look at, everything's growing with one exception, which is nuclear. Nuclear is broadly flat. It's not shrinking. It's not growing. There's steady investment into nuclear. But the fastest growing areas, hydrogen, more than tripled last year in terms of commitments from a very small base. It's $1 billion out of the trillion. So it's 1,000th of the total. You can barely see on the chart, but it's growing quickly and it tripled. Carbon capture and storage also tripled last year, or I think was just short of tripling last year. And it was about $6 billion in terms of new investments. And carbon capture, those facilities are across a range of different sectors. There's carbon capture in the power sector, in the oil and gas sector. There's direct air capture, different flavors of it. So those are probably the fastest growing areas. And that's great to see, because those are the areas that we need to mature and to scale over the course of this decade. Like, we want them to be successful because they're going to drive the next phase of decarbonization out into the 2030s.
Yeah, I mean, one thing about hydrogen is it was $1 billion, as you say, and renewables like wind and solar were over $500 billion. But I feel like we talked about hydrogen more than we talked about anything. So I think for the amount of investment, it's certainly getting a lot of hype.
Yeah, it's getting, and it's not nearly as established as nuclear. Can you just, for the nuclear fans on our podcast, talk about why nuclear never seems to get any traction, even though it's an amazing baseload, high energy density product for joules?
Look, I think nuclear at the right cost and all of that is absolutely part of the solution for the energy transition. It's baseload, clean power, practically zero carbon emissions. But I think probably this was a couple of issues. One is, I think after the Fukushima accident, more than a decade ago now, I think a number of countries decided they didn't want to go that way anymore for safety reasons. But I think there's also still a lot of question marks around the cost. And, being in the UK, we have this story of Hinkley Point C, where the costs have just continually ballooned higher and higher over time. And at the point where, you have to look at nuclear and say, there is an economic problem here, that, these are not cost competitive technologies and they don't look like being at the moment. So I think that's the challenge the sector faces. Now, can we tackle some of that with small modular reactors? That would be brilliant. Like, if we can get those kind of 50 megawatt size plants going so that you can start to drive economies of scale. So it becomes more of a manufacturing technology rather than an engineering technology, then hopefully you can start to have more rapid deployments. But I think right now, you've got to look at it and go, the costs are pretty challenging.
Well, we've covered a lot of ground here. I'm a big believer in small modular, so I really do hope that technology proves out to the people that are championing it to be the safer option and the lower cost option. Now, you also track clean energy investing in Canada. Any thoughts on Canada? How much is being spent and what are the areas of spending in the Canadian versus others?
Yeah, so Canada's clean energy investment is actually growing quite rapidly. It was $14 billion, according to our definition, our scope last year, and more than doubled actually over the last couple of years. So it's growing well. And I guess just for sort of context, 14 billion, I mean, it doesn't sound like much compared to China, but it puts Canada just outside the top 10 of our countries ranked in 2022. So it's a significant market and growing well.
So to be clear, like the 14 billion would include the sales of electric vehicles all the way to solar panel installations and...
Yeah, renewable deployments and EV sales make up a decent chunk of that. But Canada's also a leading market for electrified heat. So that's our residential heat pump figures where we include that because it's kind of demand electrification. And that's good to see. And then it doesn't reflect in the numbers just yet, but looking forward, I think there's really exciting opportunities around hydrogen and carbon capture. Again, those smaller markets that are now going to grow. Clearly, there's a real core of expertise and competence in Canada around the oil and gas sector that's going to be leveraged into these new clean energy technologies. And I think with the new tax incentives that are coming in with hydrogen and CCS in Canada, I'm optimistic that we're going to see a lot of momentum there.
Mm-hmm. So there's tax incentives and lots of incentives, but on the other side, there's a lot of instability in banking, a general feeling of increasing risk aversion. Of course, there was the Silicon Valley Bank, which was lender to a lot of upstart tech companies, including a lot of clean energy companies. So how do you see the financial system's woes at the moment affecting clean energy investment in, let's just say, the Western economies going forward?
We've been thinking about this for many years because a lot of the clean energy sector grew up in a low rate environment during the 2010s where, money was more or less free. So for many years, we've thought, what on earth is going to happen to the sector when rates rise and financing becomes more constrained? And actually, what we've observed over the last year or two is that it hasn't actually had such a huge impact. And I think there's a couple of reasons for that. I think one is that certainly the bulk of the money is still going to renewable energy. And the fact that these technologies are cost competitive in most of the markets, when competing against coal and gas, I think it means that there's more room to absorb higher costs of capital. And it's not straightforward. I think in emerging markets is a different story. But, by and large, you can say that the economics still work and the capital's still there. But I think the other point is that over the last few years, we've just seen so much appetite from the buy side, from the investment community to gain exposure to green, low carbon investments and assets. And you can call it ESG or not, but there's appetite out there. There's money being allocated to target these sectors. So in a way, I think the industry has been somewhat insulated from what's going on in the wider market.
Yeah, I mean, it is interesting when you think about this SPAC era, late 2020 and 2021, how much clean energy equities have come off since then, and still growth in the new capital being deployed. In the past clean tech eras, when something like that happened, the money just stayed away for 10 years or more, right?
Well, I agree. But all of this stuff is fairly new, this banking instability, the continually rising rates. To me, it's to be seen yet what the impact is on the whole investment paradigm into clean energy. It's been amazing over the last dozen years, but things have really been upended on the capital market side. So, we'll see what happens.
Well, and like Albert told us, you got to actually grow 3 times if the annual rate we're doing right now to get to the net zero.
On a real basis, as I said, not on an inflation. You got to adjust for the inflation too. Well, Albert, thank you for joining us, Deputy CEO, Bloomberg New Energy Finance, or BNEF. It's been really great having you to provide us insights on some of the trends that are happening in the world of energy, especially new energy. And I learned a lot. Yeah, thank you so much, Albert. It was a great conversation.
That's my pleasure. Thank you so much for having me. I really, really enjoyed our discussion. Thank you.
And thank you to our listeners. If you enjoyed this podcast, please rate us on the app that you listen to and tell someone else about us.
For more ideas and insights, visit arcenergyinstitute.com.